Welcome, ladies and gentlemen. My name is Peter Yusuf. I'm the senior analyst of IronFX. Now, together we'll be going through a small presentation about the week ahead in the FX markets. Before we start, though, our risk warning and our disclaimer. Please note that our products are traded on a margin and carry a high level of risks, and that it's possible to lose all your capital. Now, these products may not be suitable for everyone, and you should ensure that you understand the risks involved. The information in this webinar should not be considered as an investment advice or investment recommendation, but instead as educational material only. This material is just the personal opinion of the author, and clients' investment objective and risks tolerance have not been considered. IronFX is not responsible for any loss arising from any information herein contained, and any redistribution of this material is strictly prohibited. Now, as the markets are still in a wait-and-see position for the crisis in the Ukraine, which tended to shake the markets in the past few days, with the possibility of tensions easing somewhat. In the coming week, on the monetary front, we note from New Zealand RBNZ's interest rate decision on Wednesday. Yet a number of policymakers from a variety of countries are planned to make statements and could sway the market's mood. As for financial releases, we note an early start. As on Monday, we get the preliminary PMI readings for February of Australia, Japan, Germany, France, the Eurozone as a whole, and the UK. On Tuesday, we note the release from the US of the preliminary market PMI figures for February, as well as the consumer sentiment indicator for the same month. On Wednesday, we note the release of Australia's wage price index for quarter 4, while on Thursday we get from Australia the capex rate, also for quarter 4. Yet we would like to highlight the release of the second estimate of the US GDP rate for quarter 4 2021. Finally, on Friday, we get France's preliminary CPI EU normalized rate for February, and we also note the release of the US durable goods orders for January. With no time to waste, we move to the US dollar, and this would be the USD index for our chart. And a sideways movement, yet with some bearish tendencies. Nevertheless, despite having lower peaks, we seem to have a stabilization, and shows are not moving. So practically, given also that the RSI indicator below the 4-hour chart is running along the reading of 50, implying rather indecisive market, the Bollinger Bands are converging, implying lower volatility. We tend to maintain a bias for a sideways movement to come for the USD, probably between the 96.15 resistance line and the 95.60 support line. Now, 95.60 has proven its worth, as it has provided resistance here, support here, and some commotion here. While even lower, we note the 95 support level, and even lower than that would be the 94.60, which would practically be also the lowest point in our chart. To the upside, besides the 96.15, we also note the 96.65 and even higher the 97.15. Moving now to USD's fundamentals. As we have noted, the US dollar was rather steady in the past few days with little change. It should be noted, though, that the release of the Fed's January meeting minutes did not excite traders that much. The minutes showed the worries of the Fed policymakers regarding inflation and the tendency to tighten the bank's monetary policy in order to curb inflationary pressures in the US economy. Yet the minutes may have failed to reach the market's hawkish expectations, as some members seem to have a more moderate response, and the bank did not seem to commit to a certain rate hike path. The release last Wednesday practically allowed the USD to slip lower, while US stock markets showed some mixed reactions to the news, and gold's price was allowed to recover some of the losses of last Tuesday. On the other hand, Fed policymakers are scheduled to speak in the coming week and could sway the market opinion, as did St. Louis Fed President Bullard last Monday, when he stated the idea that a full point rate hike could be achieved by July. Now, despite lots of chatter about Ukraine, the US dollar seemed to have been little affected, in contrast to the common currency, which feels the heat of the issue. Nevertheless, some safe haven flows seem to be present in the past days for the USD, which were generated by the issue. As for financial releases, we note the release of February's preliminary market PMI figures on Tuesday, as well as the release of the US Consumer Confidence Indicator for the same month. On Thursday, we highlight the release of the second estimate of the US GDP rate for Q4, and you can see the relative chart in your screen. Practically, we may see that despite the deceleration from Q2 to Q3, should there be a recovery and an upward motion, that could provide some support for the US dollar, as it would imply that practically growth for the US economy had accelerated in the last quarter of the past year. On the second note, on Thursday, we would also like to note the release of the weekly initial jobless claims figure. On Friday from the US, we get January's consumption rate, as well as the durable goods orders growth rate and February's final University of Michigan consumer sentiment indicator. Moving now to the pound, and this would be cables for our chart. Now, despite some upward motion being observed in the past few days, today's stabilization tended to imply that there may be some breaking of the upward movement. I would like to see the pair actually aiming for the 1.3720 before once again switching in favor of a bullish outlook for the pair, if not even reaching it. Higher than that, we would note also the 1.3830 and even higher the 1.3980. To the downside, we note the 1.3430 and the 1.3275. We should note though that the RSI indicator below the 4-hour chart is between the readings of 50 and 70, which could be implying that the bulls have the advantage here. So, for the time being, a bullish outlook could be confirmed should the pair actually start aiming, if not reaching, the 1.3720. Moving now to the pound's fundamentals. At this point, it should be noted that the UK headline CPI rate for January accelerated, reaching a new 20-year high, indicative of the inflationary pressures in the UK economy, which are squeezing purchasing power for wages. In the UK employment market, despite a negative employment change figure for December, the unemployment rate did not rise, while the average earnings growth rate seems to be accelerating, feeding further the inflationary pressures in the UK economy. Hence, the pressure on the BOE to act remains high, and it's characteristic that the market seems to be pricing in another 5 rate hikes in the current year, with the first 3 being fully priced in until the June meeting, as these lines are written. On a fundamental level, the inflationary pressures in the UK economy increase the discontent of the public against the UK government, in addition to the delicate position UK PM Johnson got after Partygate. The narrative over the scandal now includes also the idea that the UK Prime Minister actually damaged the image of the UK abroad. And more worrying for PM Johnson is that the criticism derives not only from the opposition Labour Party, but also from his own party, the Tories. On a political level, the UK government tries to deflect the pressure by taking a more active role in the crisis in the Ukraine, yet the results seem to remain poor for now at least, and if further political instability could weigh on the GBP. As for financial releases, pound traders had to have a rather light calendar, yet we highlight the release of February's preliminary PMI figures, with the heavy point being placed on the services sector that comprises a large part of UK's GDP. That's on Monday. We would also like to mention the release of the CBI indicators. You can see the relative chart in your screens. Note how the retail indicator, the distributive trades, corrected higher, while industrial orders indicator, that's the blue one, remained rather stable. And the releases are to be for the industrial orders on Tuesday and for the distributive trade on Thursday. Moving now to JPY, this would be USD JPY's 4-hour chart in a downward movement, characterized by a downward trendline, of course. Now, we tend to maintain a bearish outlook for the pair as long as it remains below the downward trendline you can see in the chart. In such a case, we may see the pair aiming for the 114.45. Lower than that, we note the 113.70 and even lower the 112.65. To the upside, we note the 115.45. Higher than that would be the 116.30, which also marks the highest point in our charts, and even higher the 117.50. Moving now to the fundamentals for the Japanese yen. On the fundamental level, it seems that there are thoughts for border controls to be eased by lifting the number of people allowed into Japan, while quarantine periods are to shorten, all to come to effect from next month. Now, the currency's dual nature as a national currency and a safe haven instrument was on display once again in the past few days, and we would expect it to maintain that role in the coming week as well. Hence, safe haven flows could prove to be the main driver of JPY's direction, especially given that the Ukrainian crisis has not been resolved yet and remains tense. Now, the Japanese economy seems to improve its performance, as for the last quarter of 2024, the GDP growth rate got out of the negatives and accelerated, showing growth once again. On the other hand, the inflation growth rates for January have slowed down more than expected, adding to further headaches for BOJ. The bank had and continues to maintain an ultra-loose approach regarding monetary policy in an effort to boost inflation. It should be noted that the bank undertook an operation to buy an unlimited amount of 10-year bonds at a fixed rate of 0.25%. in order to prevent yields from rising further. Overall, though, the bank is also expected to maintain its dovish approach, given that the inflation rate is below the bank's 2% target. Please note that the measures seem to apply for any major market activity. As for financial releases, we note on Monday's Asian session the release of the preliminary Japan manufacturing PMI figure for February, while on Friday we get Tokyo's inflation metrics for the same month. You can see the relative chart in your screen right now. Practically, Tokyo's CPI rates gain on attention because Tokyo has a high proportion of the total Japanese population, the high density of population as a city, and hence analysts tend to have a look at the Tokyo CPI rates in order to better understand how inflationary pressures in the total of the Japanese economy are evolving. And in this case, we can see that from December to January, both the core rate, which is yellow, and the headline rate, which is the green, were on the downside, practically foreshadowing a possible easing of inflationary pressures, which could be a negative for JPY should the easing be continued also for February on Friday. Moving now to the common currency, Euro USD. For our chart, a steady sideways motion just below the 1.1370, actually revolving practically around it. We tend to maintain the bias for a sideways movement, given also that the RSI indicator below the 4-hour chart is at the reading of 50, implying a rather indecisive market. Note how the Bollinger Bands are converging, implying or reflecting, if you prefer, the low volatility for the pair. Nevertheless, the direction could alter, and should the bulls take over, we would expect the pair to clearly break above the 1.1370 and to reach the 1.1435 for the bullish outlook to be confirmed. Higher than that, we would also note the 1.1482, which provided resistance around the 13th to the 14th of January, actually reversing the upward motion of the pair to the downside, and should the bulls take over, the first stop could be the 1.13, which provided some support here, here, and here. Lower than that would be the 1.1235, and even lower as an ultimate bearish scenario would have the 1.1180. Moving now to the common currencies fundamentals. The Ukraine crisis still dominates Euro's fundamentals. The market's worries about the crisis in Ukraine seem to have eased a bit on Tuesday, as the Russian side's rhetoric maintained the narrative that Russia has no plans to invade Ukraine and a diplomatic solution is still possible, while at the same time a partial pullback of Russian troops, which was near the Ukrainian border, was also reported. The developments tended to underscore a possible de-escalation and an easing of tensions, yet the situation seems to remain critical. While US President Biden made a passionate appeal to Russian President Putin to avoid a war in Ukraine, the US President also stated that it is still possible for Russia to invade Ukraine, and also stated that the US has not yet verified Moscow's claims that it has withdrawn some forces. On the contrary, in the most recent development, the US and the UK seem to see Russia still building up forces, a claim that Russia has downplayed but still continues to feed the market's uncertainty. Also on a fundamental level, the good news are that Germany plans to end the COVID-related restrictions. That's by late March. Yet we must note that the news provided little if any support for the euro. On the monetary front, ECB's narrative that the inflationary pressures are transient seems to be shifting. ECB's chief economist Philip Lane stated yesterday it looks unlikely that inflation will drop below 2%, which is the bank's target in the next 2 years. Such a shift in the bank's stance regarding inflation could imply a faster tightening of ECB's monetary policy. Should more ECB policymakers also imply a faster tightening and confirm the shift of the bank's stance, we may see the euro getting some support. As for financial releases, we note on Monday February's preliminary PMI releases for France, Germany, and the Eurozone as a whole, with the heavy point being the reading for Germany's manufacturing sector. Please note that Germany's manufacturing sector is practically depicted in the blue line. Note the slight upward movement which was reached on January, implying a fast expansion of economic activity in the crucial German manufacturing sector, while on the other hand France's services sector dropped, affecting practically Eurozone composite PMI to slightly drop as well. Besides that, on Tuesday we get first Germany's IFO indicators for February, as well as March's GfK consumer sentiment. On Wednesday we get France's business climate for February, as well as Eurozone's final HICP rate for January. Finally, on Friday we note France's final GDP rate for quarter 4, as well as Eurozone's economic sentiment for February. Moving now to the Aussie. And this would be AUD USD's 4-hour chart. Now, AUD has an upward motion against the US dollar. We have consecutive higher lows, higher peaks as well. It's currently aiming for the 0.7230. Please note that the RSI indicator below the 4-hour chart is between the readings of 50 and 70, also more or less supporting the notion of a bullish sentiment in the market. I would like though to see the price action actually hitting, if not surpassing, slightly the 0.7230. For the time being we tend to maintain the bullish outlook, and we would expect the pair to break above the 0.7230 R1 and aim for the 0.7275, which practically provided some resistance here and was aimed for here. Higher than that would be the 0.7315, which is also the highest level reached by the price action in our chart. And to the downside, we would note the 0.7170, lower than that the 0.71, and even lower the 0.7015. See how beautifully practically the downward motion was reversed at that level. That was around the 4th, 5th of February. Moving now to the fundamentals of the Aussie. On a fundamental level, we note that as a commodity currency and a risk barometer, market mood could have a significant effect on AUD's direction. As should the market sentiment be more risk-oriented, AUD could enjoy some support, while if the market is more cautious, the Aussie may retreat. Also, we must note that efforts for AUKUS, the alliance of Australia, UK and the US, are ongoing, with Australia nearing a deal with the UK for the supply of nuclear-powered submarines. The matter could provide for new tensions in the Sino-Australian relationships, with possible adverse effects on AUD. On the monetary level, RBA seems to be viewing the economic situation in Australia as closer to its targets, yet at the same time seems to remain rather patient. Sorry about that. The February meeting minutes released on Tuesday showed that the bank's board is still unconvinced about the acceleration of inflation in a sustainable way, and seems to be placing weight on whether wages are to accelerate their growth for that perspective. It should be noted that RBA Governor Lowe last week had implied that a rate hike could come earlier, even this year, if the economy continues to beat expectations, which signaled a shift from prior forward guidance. Hence, we highlight the release of the wage price index on Wednesday for Q4 2021, and should the rate accelerate further, we may see RBA getting additional confidence, which in turn could support AUD. On Thursday, we note the release of the CapEx growth rate for the same quarter, with a possible acceleration signaling more confidence on behalf of Australian businesses to actually invest in the Australian economy and vice versa. You can see the relative chart in front of your screens. Note how capital expenditure was slowing down from Q1 to Q2 and actually declined into the negatives in Q3 2021. Now, besides that, we would also like to highlight on Monday, Asian session, the release of Australia's manufacturing sector preliminary PMI figures. That's for February. A possible higher reading could imply that there was a fast expansion of economic activity in the sector during the current month. Moving now to the CAD, and this would be USD CADs for our chart. Now, the CAD was in a sideways motion between the 1.2785 and the 1.2660. Nevertheless, some bearish tendencies seem to be present, but the chows seem to remain constant, implying that the 1.2660 is holding its ground. Hence, we underscore its strength as a support level. Lower than that would be the 1.2585, and even lower than that, the 1.2495. To the upside, we note the 1.2785, and even lower the 1.2850. Sorry, even higher, the 1.2855, and the highest level noted would be the 1.2945. On the fundamentals of the CAD, we start with BOC, and on the monetary front, the hawkish expectations of the market for the bank are still present, as it prices in 625 basis points rate hikes to come in the current year, with the first one occurring in March meeting, and the first 4 rate hikes being fully priced in by the market currently. It was characteristic how BOC Deputy Governor Timothy Lane stated that we will be nimble and, if necessary, forceful in using our monetary policy tools to address whatever situation arises, practically reinforcing the market's hawkish expectations. At the same time, loony traders are to keep a close eye over oil prices, which also seem to stabilize somewhat and are heading for a weekly fall after being in the greens for 7 consecutive weeks. Now, the prospect of extra supply from Iran returning to the market seems to overshadow fears of a supply tightening arising from a possible Russian invasion of Ukraine, at least temporarily. Diplomats said that draft accord outlines a sequence of steps that would eventually lead to granting waivers on oil sanctions. That could bring about 1 million barrels a day of oil back to the market, but the timing is unclear, always according to Reuters. No major high-impact financial releases are expected from Canada, hence we would expect fundamentals to take over in the coming week. As possible, positive market sentiment could provide tailwinds for the CAD and vice versa. As a general comment, and before we leave you, once again, in the coming week we may see the USD dominating the FX market, especially given the gravity and frequency of US financial releases. Still though, we may see on a number of occasions other currencies taking the lead and getting out of the USD's shadow. As for gold, we would expect the negative correlation of the precious metal to be on display, albeit we must note that in the past weeks that tendency was broken at some points, mostly due to the tensions in the Ukrainian crisis. On global fundamentals, the Ukrainian crisis is expected to continue to dominate discussions among traders, as it could affect the markets and especially safe haven instruments with outflows should tensions be easing. On the monetary front, we would like to make a small comment for RBNZ's interest rate decision on Wednesday. The bank is expected to perform a rate hike of 25 basis points, and the market has fully priced in such a scenario materializing at the moment. Thus, should the bank actually hike rates as expected, we may see NZD getting some support in the face of an actual tightening of RBNZ's monetary policy. Yet, as such a scenario is already fully priced in, the market may be more interested to see whether the bank is to continue to maintain a hawkish stance. Hence, attention could be placed on any possible forward guidance which is to be provided by the bank. Also, RBNZ Governor Adrian Orr's press conference is to be closely watched for any hints towards that direction. That should sum it up from all of us here at IronFX. Best wishes for solid trading.